Show.
Personal Finance with Warren Ingram.
That's his name. He is also a personal financial advisor. He's an executive director at Galileo Capital. On a Thursday night, he makes himself available to you for 27 and a half minutes, and he shares his wisdom from the world of money and personal finance. He is a triple book writer. His most recent book was all on how global investing made easy. He also wrote a book on how to make your first million. He also wrote a book on how to be your own financial advisor. And he still has time to share with us on a Thursday evening how to decide when to sell a share that has lost money. I've just drawn a little graph, Warren, and say you buy something at 100 and it goes up to 200 and you're beginning to feel like a bit of a genius. It goes down to 150 and you start getting a little bit panicky because this share was only going up and only going one way. It gets back down to 100 and you think to yourself, I can't possibly sell it now. If I do, I've waited a year and I've done nothing. I should have sold it at 200, could have, should have, would have, but I didn't. I'm going to wait for it to get back to, oh hell, it's gone to 50. Oh no, it's at 40. Oh no, it's at 20. You know what I'm going to do? I'm going to take another 100 and I'm going to buy them at 20 Rand because I bought them at 100 and they went to 200. So if I buy them now at 20, I'm going to quintuple down. And so you do that and it goes to 10. That happens a lot, doesn't it?
It does. I mean, I think we've got the stock markets are full of those stories all around the world, not just here. But I mean, to me, the most recent example that always comes to mind when I'm thinking of this kind of, in listening to your example, it was kind of flashing in my head was Steinhoff. Where people, watched that share shoot up, for a long period of time, and really lots of FOMO going on where people just thought, I have to buy it. It's going to go up and up and up, and I'm missing out. And lots of people bought that share, close to the peak. And then it started to fall. And it's amazing how kind of my inbox started to fill up with people saying, don't you think now it's lost half its value? It's now time for me to buy. This thing, it's impossible that it's going to go to zero. There's no way. Great business. This is not a big issue. And so lots of people piled in, hoping to kind of select a bargain. And it ended up at some point losing 99% of its value. And I think it burned a lot of people that were simply buying the share because of a move of a price, without any real focus on what is the business, what am I actually physically buying. So you're right, it's a horrible and scary story for a lot of people, when they hold a share and they just watch it go down. And talking to producer Takiso before about this, and he was saying, he's got a bad habit of, I have to quote him here because it was the best saying I've heard all day. I have a bad habit of holding on to dogs thinking they will turn into cows. and I think it's perfectly apt. We've got to figure out what's a calf and what's a dog. And I mean, I love dogs, but, I guess there's a production element here and dogs are not going to produce new cows. So I take the point, and I think it's, to me, when you look at this, there are a couple of things you have to focus on. And one of them is, do you understand the business you've bought? Yes, it's a share, and yes, the price shoots up or shoots down. Regular listeners to us over the years would have said, a lot of the time we would be saying to people, be fearful when others are greedy and be greedy when others are fearful. And that's an absolutely true statement that Warren Buffett has taught us all. But you still have to understand what you're buying. And because a share has just lost value, is no reason to either buy it or then to sell it. You really have to understand the business and ask yourself some key questions before you make that decision.
And you can understand the business as well as you like, but if the business is operating in an environment that is not conducive to that business, you might run the world's best construction company, but if nobody's constructing anything, you can be as good as you like. You're not going to get any income. You can run the world's most wonderful chocolate factory, but if there is a global diabetes scare and people stop buying chocolate, well, you can have delicious chocolate that no one's going to buy, and that's the problem, I suppose, with investing. So often we think we know what we're buying, but we don't fully appreciate it in its context at a particular moment in time.
Yeah, and I think it's one thing about markets is as soon as we feel like we've got a grip on what's going on, they will humble us, and that that's a reality for people that have been in the market for 5 years and some who have been in it for 50 years. We just have to know that sometimes with all the best intent and all the best research in the world, life happens. We end up making a mistake for all the right reasons, and so I think when you're in that situation, just understand that something losing value quickly doesn't mean that the business ends. And a great example for me is the share of Apple. So over a 10-year period, it's up over 1,200%, but in at least 4 times in that 10-year period, it's lost a quarter of its value in a short period of time. And that must have scared the daylights out of investors. They have this brilliant business that they really love. Lots of people have only own one share, which is Apple. And so, for them to see their real wealth just drop by a quarter, that's a big number.
And the trouble is, when shares like this are falling, there are plenty of good reasons for them to be falling. There's new competition. They're not innovating fast enough. The new iOS isn't operating as well as it should. Who's going to use new apps or whatever the case might be. There's always a good story to be told on the way up, and there's an equally compelling story on the way down as to why you should be running for the hills.
Yeah. And so now you have to make a sensible, rational decision when potentially everybody else is being irrational. And truthfully, that does happen a lot. So don't just assume that you're the only crazy one, or you're equally crazy with everyone else. Sometimes you might be the rational person. But you still have to find a way to give yourself a context to making these decisions. And I think the first thing is just zoom out a little bit. You might be incredibly focused on the one share or the 3 or 4 shares that you own, and you feel like the world's ending because your share or shares are down. You have to zoom out and say, okay, hang on, let's just stop and look around. Are all the shares in the JSE or the global markets, are they all down? Is there a context to this where the tide is just going out on the stock market in general, and my share happens to be one of those? And I feel that that's probably a very apt description for what's going on in the tech sector at the moment. Lots of very strong, very good businesses that were overpriced. Their share prices are falling, but they are still going to be in business, next year and maybe 3 or 4 or 10 years later. So when that tide goes out and you understand that it's all shares or most shares in the market, then don't panic that your share is going down. There is a good reason. Then it's a market event. It's not a share event. I think also just always try and understand the business. So let's use the Apple example. The share is going down. Maybe they're not innovating. There will be lots of critics of a company that's performed very well. We could say the same around Amazon. But then just understand, is it still selling its products? Does it sit on a lot of cash? And because an interesting thing about a very strong business is if it doesn't have a lot of debt and it's sitting on a lot of cash, they might be using this opportunity to be buying out, current or future competitors and using this as a fantastic market opportunity to grow their businesses in a new direction. And I think a lot of the time that's a big signal for me is, when the share price is falling and markets are falling and a business is sitting on too much debt, that's a surefire sell signal for me. I think that was when people were asking me about Steinhoff, I had no special knowledge of what that business was going to do. But what I did know was it was sitting on, billions of rands and euros in debt. And there was just no way I could see how it would pay that. The same story with African Bank. So I think that becomes a great signal.
However, share prices are falling and the dividend yield is improving. Oh man, this thing, I paid 100 for it and it had a dividend yield of 3. Its share price went to 200 and the dividend yield was 1.5. Now it's fallen to 50 and the dividend yield is at 6. And actually it's increased. So because they pay a bit more of a dividend, so the dividend yield is at 7%. This is just fantastic. Not only has the share price fallen, but as a result of a cheaper share price, the dividend yield that I'm going to get is going through the roof. I must have this thing. And that's a wonderful trap that many people fall into as well.
It is, and so I think the thing to look at there is, is the business still generating a lot of cash? Are the prospects good? The fact that there is a market event, is it actually affecting the way that the business operates on a day-to-day basis? Because some businesses might be generating, a great dividend yield, but actually their ability to sell into maybe a shrinking economy is going to be severely compromised, and whatever dividends they're earning right now are not going to be repeated. In which case, a great dividend yield is a smoke signal. It's actually just a trap that's going to help you catch a falling piano. And the only thing you should do with a falling piano is run away. Don't try and catch it. However, if you're in a share where the business of that company is doing very well and is largely unaffected by a share price, then all you've got is hype around you. And when the share price has fallen, the dividend yield has doubled as a result. My view is that's the time to be buying. If you understand the business well and you don't think it's being compromised, great. The market's given you one of those opportunities, which it regularly does, to buy a great business at a heck of a discount. And then the dividend yield should be, the kind of the big for sale sign. Buy now.
It's tricky, though, isn't it? Because also we get quite wedded to historical performance. We think because it was once at 100, it's going to go back there. And I think a lot of people are trapped under those sort of circumstances often as well.
And I think it's such a brilliant point. History, especially what you paid for a share, it's exactly that. It's just history. It's a number on a spreadsheet. It's a piece of paper where you've written something down somewhere for yourself. It gives you no indication of what's going to happen tomorrow or the next 10 years. And so when you own a share that's done incredibly badly or incredibly well, whatever you paid for it is only relevant for your tax reporting. The thing that you need to decide is, if I had 100,000 Rand today and I was going to allocate it to one share, would this be the share? If it was a share you would buy today because you understood the business, you believed in the business case, and you were happy to pay that share price as it is today, then that's a great signal that you should continue to hold the share. Whereas if you were saying, no way, there's absolutely no chance I would allocate any money to the share, the fact that you then currently own it and you've lost half your money, another great signal to sell. So you're right, Bruce. I think history is a great way of luring us into mistakes sometimes. And I think we just have to park it and say, that's going to be a painful, school fee that I've paid now, and I'll learn from it. But don't be a trap, waiting for, the worst phrase I think in this whole situation is, I'll just wait for it to recover to what I paid for it, and then I'll sell the share. That's a terrible logic. You need to say, I wouldn't allocate any money to this. I have to sell it now and allocate it to something else, which I believe will do well. And I think that's the key. And it's, what are your other opportunities, and are they much better than the share that you own today? And if they are, take advantage of the new opportunities, because they might also be on sale, especially in this environment.
Cut your losses? Absolutely. Question from George this evening, which we'll get to in a moment. I need some tips on how I can go about investing a lump sum that I've inherited. Most of my investments are in South Africa, so I'd like to use this money to invest offshore. I keep hearing from different market commentators that the US market's expensive, but the performance is still good, and I'd like some of that exposure in my portfolio. Where's the best place to invest this money that I can get some offshore exposure? Should I invest it all at once? Many thanks, George. Good question, George. More on that in a moment.
The Money Show.
Personal Finance with Warren Ingram.
George has got some money. He's inherited it. We don't know how much, Warren, but would like to invest offshore and wants to know whether or not he should do it all at once. He's a little bit worried about prices and valuations, and he hears they're expensive, which suggests to me that he is relying on third-party information rather than digging too deep himself. That's my concern, but what's yours?
Not a tremendous amount. I like his logic in this. It's not like he's sort of jumping at some other fad. So I think you're right that he's also aware that he doesn't know. But what I love about this is, it's not saying I've heard this this investment has skyrocketed by 1,000% and I want to get in before it's too late. So my main concern will be, that the logic of getting exposure offshore, I think, makes sense. Just be careful that you're not kind of overexposing yourself to the international markets, where you end up with too much money outside of the country and no ability to cover your expenses in the country. And at the same time, don't put so little overseas that it doesn't really give you any performance benefit, from a diversification point of view. So I think it's a good call. I think the first decision, though, George, is you need to say to yourself, I've got to have a target for the rand dollar first before I do anything. So if the rand were currently at 17 Rand to the dollar, My view is that's too expensive. In other words, the rand should be a better exchange rate than that. And for a while now, I've been saying my level is about 15 Rand 50. And it feels like, depending on the minute at the moment, it could be 15 Rand 50 or it could be 15 Rand 30. It seems to be the range that it's been trading in for a while. So if it's below 15 Rand 50, then by all means, start to get that offshore exposure. But the other thing just to be careful of here is don't overexpose yourself to one market internationally. So you're looking at the US. I would be saying, look at the world rather. I mean, literally, buy the world, buy the world index if you will. I think it's a good place to go, but don't narrowly just focus on one country, one geography, because there are they were expensive, but there were some very big tech businesses that were massively overpriced a little while ago, and in the last few days and maybe a week or so, they've certainly come down. And so the US is significantly better value than it was, but it would be a heck of a stretch to say that it's good value. I think it's still quite expensive. So rather buy the world. And how do you do that? Well, my view is buy the world index. You can do it in South Africa. Most of the big exchange traded fund providers in South Africa will offer you a world index, and you can buy it here. Or you send your money overseas, open a stockbroking account, and buy the world index there. Should you do it all at once? I think if you're trading in a fairly large amount of money, then maybe spread it out over 3 to 6 months. But if it's a smallish amount of money, and by that I mean, let's say less than 20,000 Rand, then rather just buy it once when the Rand is in your favor. So that would be the spread. Is just spread your not your bets, but spread your views, diversify. Don't be all in America all at once. And then spread it over time if you've got a significant amount of money where you can spread out those transaction costs.
Fantastic. Thank you, Warren Ingram. I'm sure George will be delighted with that answer. What is a monopoly? It's a board game, isn't it?
I actually almost predicted that you would say that. So you're correct. It is a board game, and so in the investment sense, a monopoly is a business that has absolute control of its market. In other words, if we think back a few years ago, in South Africa, Telkom was the only business that you could get to provide you a telephone of any description, and so that would, in the purest sense, be an absolute monopoly. And the thing about monopolies is they can either be a government-regulated thing where the government says there is only one post office, doesn't matter how good or how bad it is, this is the post office and you may not compete with it. Or it may be a business that naturally just grows into a monopoly over time. And so we don't like those in the free markets because often monopolies can destroy competition and become inefficient in themselves. And I think that's a big issue for the big tech businesses now. But yeah, so monopoly is something that controls an entire market. We don't like them. We want at least 2 or 3 competitors in any big market to be efficient.
Unless, of course, there's a private sector monopoly that you can invest in. And then you want to be invested in, provided it's well run. Of course, SAB was a great example. They had a virtual monopoly on the beer market for an awfully long time and turned out to be a fantastic investment. But that's maybe a story for another day.